Hi, Dr. Rao. Hi, Ajay. Hi,
Hi,
guys.
Janvi. Hi.
Greetings, panelists. Good afternoon. The webinar is live. We'll be starting in the next 30 seconds.
You are expecting 80.
Good afternoon, everyone. Thank you for taking the time and joining us today. On behalf of Krishna Institute of Medical Sciences Limited, we welcome you to the virtual brokers and analysts meet on the announcement of the company's forthcoming IPO.
Recording
Before
in
we
progress.
I'd like to introduce you to the company management and the distinguished guests on the panel today. From the company, we have with us Dr. Bhaskar Rao Bolineni, Managing Director, Dr. Abhinay Bolineni, Executive Director and CEO, and Mr. Vikas Maheshwari, the Chief Financial Officer. Representing the BRLMs, we have Mr. Chunky Shah, Vice President of Healthcare at Credit Suisse Securities India Private Limited, Mr. Shirish Chikalge, Vice President IIFL Securities Limited, Mr. Nitesh Goyal, AVP of Healthcare and Pharma at Kotak Mahindra Capital Company Limited, and Mr. Neeraj Purohit, Vice President at Axis Capital Limited. All attendees' microphones have been placed on mute. After the presentation, we will open the floor for questions. The questions can be typed in the Q&A panel available to you, and they will be read out to the management on completion of the presentation. I now invite Mr. Chunky Shah from Credit Suisse Securities India to initiate the proceedings. Over to you, sir.
Thank you. Good afternoon, everyone. Thank you all for taking the time to attend this broker meet for KIMS Hospital. On behalf of Credit Suisse and other BRLMs, we are very proud to bring this exciting opportunity to the market. I would like to thank General Atlantic and the promoters for providing us the opportunity to be a part of this exciting IPO journey. Let me start by introducing the management team. We have Dr. Bhaskar Rao, who is the founder and MD of the company. He is a renowned cardiothoracic surgeon with over 27 plus years of experience. He started KIMS in 2000 with a vision to provide high quality care at affordable prices. We also have Dr. Abhinay Bolineni. He is the CEO of KIMS. He holds a degree in medicine surgery from Deccan College of Medical Sciences. Dr. Abhinav has played a key role in growth initiatives and was named in Business World's BW 40 under 40 list in 2019. We also have Vikas Maheshwari, who is the CFO of KIMS. He is a chartered accountant with 24 plus years experience across companies such as Endurance, Aurobindo, and Gati. We believe KIMS is an fantastic investment opportunity in the healthcare space, led passionately by Dr. Rao and backed by a marquee investor in the form of GA. KIMS is one of the largest healthcare group in AP and Telangana with 9 hospitals and combined bed capacity of 3,000 plus beds. The flagship hospital at Secunderabad has a total capacity of 1,000 plus beds and is one of the largest hospitals in India. Dr. Rao and team have built a superior business model with focus on high quality medical care at affordable pricing with a unique doctor participation model. On the financial front, KIMS has demonstrated a stellar financial performance over the past few years with consistent growth track record and best-in-class returns. Before handing over to the management to walk you through the story, I would like to remind everyone of a few key deal specifications. Overall deal size is INR 2144 crore, which comprises of INR 200 crore of primary and rest is offer for sale of 2.35 crore shares. Employee reservation is 20 crores, hence the net offer would be 2124 crores. The anchor book will open and close on 15th of June. The main book issue will open on 16th June and will close on 18th June. The price band for the IPO is INR 815 to 825. With this, I'll hand over to the moderator and then to the management to take it forward. Thank you.
Thank you, sir. I now invite Dr. Bhaskar Bolineni to come to the fore and take us through the investor presentation. Over to you, Doctor.
Thank you for all the people who have been joined this afternoon. It's a great day for us to present taking the company to IPO. We have been built over 2 decades, Krishna Institute of Medical Sciences. This is a leading player in Andhra Pradesh and Telangana with 9 multi-speciality hospitals consisting of 3,064 beds. We are a quality, affordable healthcare, and our doctors' engagement is entirely different. We provide an advanced quaternary care while delivering clinical excellence to our patients. We have a strong track record of our operating and financial performance. Before going into the detail, I will take you to the journey. Initially, having been graduated from my medical school and as well as my post-graduation and overseas training, I started my journey in 2000 at Nellore, my home place, with 120 beds. Later on in 2002 in Rajahmundry, 120 beds, and 2004 and 150 beds in Secunderabad. These 3 are different regions, north, south, western portions of the erstwhile Andhra Pradesh. Having started in 3-4 years' time in these 3 localities, understood the healthcare and the mindset of the public as well as the talent by especially the medical and non-medical people. We understood the healthcare in a better way. And later on, the next decade, we started another 6 locations in Andhra and Telangana, which is around nearly 2,000 beds, total of 3,064 beds in 9 locations. This is the geographical representation of Andhra and Telangana, having 9 locations. We are 2.5 times of the listed player Apollo in this region, the bed capacity. We also 1.6 bed capacity of the regional player, Yashoda Hospitals. We are still the largest player in this region. As I mentioned, that we are an affordable quality care across Tier 1 and Tier 2 cities. Our ARPOBs in Tier 2 is around 11.8. Our Tier 1 is 27.4 and an average of 18.3, which is very well below most of our peers in the ARPOBs are concerned. We are doing a diversified payer mix. Whether it may be a below poverty line like state government insurance, corporates, health insurance, and the cash paying patients. By doing this diversified payer mix, we attract a large volume of population to the hospitals. We penetrate the brand very nook and corner into the entire population of Andhra Pradesh and Telangana. So we are building all the multi-speciality hospitals. It will help us in 2 ways. One, patient will get the good quality care. When being provided by all multi-speciality hospitals, the multi-specialists are available. When there is a need for the patient, they can be cured much better rather than people should come from outside the hospital. The second important thing, it will de-risk the company. We don't go with the concept of a single specialty star or maybe a single doctor star. We equally develop all the specialties in the organization so that everybody will grow with their own enthusiasm and interest and bring laurels to the organization. We also provide a good technology that is available globally, whether it may be robotic, Novartis TX, or any diagnostic as well as therapeutic tools, so that it helps the doctors to treat them better way. So that's why we provide all those things. And at the same time, we can attract a good talented doctors by seeing the good technology that is available to provide to the patients. We are unique in selecting the doctors, as I mentioned. We recruit all the doctors from a globally good institutions. Why we do that? Their entire focus will be on the patient quality care. They also give importance to the academics and research. By doing the academics and research, they also get the new therapies, new diagnostic tools, whatever available in the globe. By this, they also build a subspecialties. By doing all those things, they can able to do a teamwork so that the clinical outcomes will be excellent rather than fighting themselves in the same department. They will have very good, genuine atmosphere in the department itself. Why we selected all these things? Having been selected, these people in the reputed institutions, their entire focus will be what I mentioned. So they did the same thing to KIMS in the last 2 decades. That way we showed an excellent growth and also the patient satisfaction, a quality treatment at affordable cost in these last 2 decades. While providing all these professional satisfaction to the doctors, we also encourage them to be an equity partner. When they be an equity partner, when we started in 2003 in this organization, Secunderabad, few of my doctors who were partners or who were working with me, they joined to build the KIMS Secunderabad. At that time, whichever doctor that comes, we encourage them to buy the shares. The reason why we ask them is, whenever we have seen all these existing investors and they are exiting, they are making a good return on investment. So having been doctors are also working in this organization, they should also make a good return on investment on their equity. The equity model is nothing like any ESOPs nor a professional compensation. They should be able to buy whatever is the existing price. At that time, any existing shareholders who want to exit their personal issues, then they will buy these things. Because we have 3 rounds of private equity people, we will be able to benchmark at the time of exit of this private equity. That will be the baseline to buy these shares. Whenever the doctors wants to exit, they can able to exit. That's the way the model will be. By keeping all these, one is the good talent and as well as the multi-specialty hospitals, good operational things. The revenue growth has shown in the last 3-4 years at 26% growth and EBITDA margins growing around 29%. The ROC is around nearly 22-27% in the full year. If you look into that, we are unique in one aspect, whether it may be tier 1 and tier 2, we could able to build a good EBITDA margins when compared to most of our peers. In the blue line shows that tier 1 shows from a 33% EBITDA margins in the over year-on-year on a mature units. In the red line shows the tier 2 cities which have been achieved 20.5% EBITDA growth. 4 units has been acquired in the last 4 years. They are still growing phase. Their occupancy is around 55-60%. When they reach to the 80-85%, their EBITDA margins also 28-29%. Why am I saying that to tier 2 also achieve these EBITDA margins? Our mature units like Nellore and Rajahmundry, which started in 2000 and 2002, they are generating around 29-30% of EBITDA margins. With that, when these 4 units comes to maturity, all these things, we keep on improving our management training programs and all operational efficiency, bringing down the cost year on year. And at the same time, we are very judiciously deploy all our capex. Nearly 20-25% of the bed per bed is the lowest when compared to our peers. So with all these judicious deployment of capex as well as the operational efficiency will directly add to the EBITDA margins to grow. So with this, I think I can say that we understood, we provided a good quality, affordable care to the patients, to one of the stakeholders. The second important thing is we could be able to retain the doctors. 80% of the doctors stay since inception. That means we could be able to manage, understand the doctors community, which are the main focus for the healthcare. They continuously to stay. The third one is the investors. If you look into the investors in the last 3 rounds of exits that we have shown, they returned with a good return of investment. Apart from that, we understood the healthcare much better in the regional. As a regional, we stay focused at the regional so far. If you look into that, last 3 years back, we have been filed in DRHP, where whatever we promised, we could be able to deliver going forward the last 3 years at that time. Is the only company which delivered these things. And with this, I think what all we have done the journey in the last 2 decades growth, I have no hesitation to say moving forward, we can also show the same growth. So I will ask Dr. Abhinay to expand on the expansion and the growth in the next few slides. Dr. Abhinay.
Good afternoon, everyone. So the way we're looking at growth, so far we've grown in 2 states, Andhra Pradesh and Telangana. The approach that we have had is to build large in one state and then go to the neighboring states. So the medium to long-term plan would be to go to the neighboring states and then become a stronger regional player and then go to the neighboring regions, then become a nationwide player. But before we do that, the way we're looking at the strategy is twofold. One is to consolidate the existing markets. One is to expand beyond AP and Telangana. The way we want to consolidate existing markets is through expanding our high occupancy facilities to add more beds in those hospitals, by adding greenfield hospitals in one or two untapped opportunities in AP and Telangana, as well as consolidation and acquisition opportunity that we see in this market. So there's potential that the current 3,000 beds could potentially increase by 50% over a period of time in AP and Telangana. And that'll put us, we're the largest by twofold currently, we'll become the largest by threefold once we execute this plan. And the other reason we also want to add more beds is because we believe that we have scope to strengthen few therapies such as organ transplant, oncology, and mother and child in just an AP and Telangana. So the additional bed capacity will help us grow these therapies in those markets. Now, beyond this new bed capacity addition, we believe it might be difficult for us to add beds at a similar growth rate. Hence, we're now looking at neighboring geographies. And the approach that we have for neighboring geographies is we're trying to analyze where we get a lot of patients from currently. Where do we lose a lot of patients because of proximity? Where is the brand very familiar? Is there an ability to build a large network like we did in AP and Telangana? And how can we engage with doctors in the market? Can we do a doctor equity model? So having looked at all of this, I think the markets that scored the maximum are Southern India and Central India. I think geographically we're very blessed that we have a lot of drainage that comes in. Patient drainage happens from Central India, like parts of Maharashtra, Madhya Pradesh, Chhattisgarh, Bhubaneswar to Hyderabad for treatment. And a lot of drain out happens from southern Andhra Pradesh, which accounts for almost 30% of the population, in spite of KIMS having 4 hospitals to neighboring states such as Karnataka and Tamil Nadu. Likewise, at least 30% of Karnataka, northern Karnataka, again drains into Telangana for treatment and not Bangalore. And all this is because of proximity related or poor infrastructure in the larger cities. So I think we're geographically blessed given that we have multiple catchment areas and the brand is spread out to a lot of these places. And the ability to build a network in a place like Karnataka and Tamil Nadu and places like Central India is quite superior given the untapped market and given the opportunity to organize the fragmented sector. So I think the opportunity that we see immediately is to start building an anchor hospital both in Chennai and Bangalore. Chennai, we've already identified land. Bangalore, if not for the lockdown, we would have already closed procuring the land. And start building greenfield facilities to build the anchor hospital and then slowly look at replicating the AP Telangana model in both the states. Likewise, we're also looking at opportunities in Central India, mostly acquisitions of brownfield. And if we find something that is suitable to the way we run the facility, we'll probably quickly look at it. But having said all of this, we believe that the short-term to medium-term growth for the company will largely be driven through the existing capacity or the additional beds available in the existing hospitals for which capital is deployed. The additional beds we want to create with very limited capital in the existing hospitals and the acquisition greenfield opportunity that we see. And only a small part of the growth will actually come in from places like Chennai, Bangalore, Central India from a short term to medium term. And we will also use this time to understand the markets better, nurture the markets, establish a strong clinical team and the management team, and then see a lot more growth coming in from the medium to long term from these markets. So that's how we're looking at growth. I'll leave it to Vikas to quickly take us through operating and financial.
Thank you, Dr. Arvind. So in terms of the financials, let me start with the revenue growth and the IP and RP volume growth. If you look at on the revenue sides, we have been able to grow our revenue by 20% CAGR from FY19 to FY21. What is more important to highlight is that among all our 9 hospitals, all the hospitals grew and all the specialties among these 9 hospitals grew. So the combining together all the growth is 20% CAGR on this, backed by a robust IP and OP volume growth. In FY21, the IP and OP volume growth little bit get impacted because of the COVID-related fear and COVID-related lockdown. But we have been able to grow the revenue consistently by 20% CAGR. On the profitability side, let us look at the EBITDA. We have been able to grow our EBITDA higher than the revenue growth. And the EBITDA growth was 48% CAGR during the same period. More important to highlight is that if you look at our EBITDA margin, we have been consistently able to keep it above 20% and kept on growing year-on-year basis. The only point which I want to highlight is that in FY19, there has been 2 acquisitions which we did, and there was some operating rated losses on those units, and turning around took some 12 to 18 months time, and there was some IPO related expenditure which we have written off. If that would not have been, our EBITDA margin would have been 20% plus. As you can see on the third chart, the EBITDA margin continued to grow consistently over a period of time. Let me explain why it is going consistently up and why we are able to grow it consistently. If you look at our assets turnover ratio, in spite of we are acquiring 4 hospitals in the last 4 years, we have been able to increase our assets turnover ratio from 1.3 to 1.7 times. Means we have been able to churn out and grow our units much faster, both established units and the acquired units, which has led to growth in the existing units, which are already sitting on the huge operating leverage. So any incremental revenue coming up, the sizable portion of that is directly getting added to the EBITDA. Secondly, these 4 units which we have acquired, those are the loss-making units initially. And as we turn around them from the negative EBITDA, they become positive EBITDA. So they added to the positive EBITDA and the EBITDA margin grew up. Thirdly, as the occupancy levels continue to grow in all the hospitals, we have been able to change our payer mix in our favor. So cash and insurance as a percentage to the revenue has constantly kept on growing over a period of time. And every year 2 and 3% as a total payer group, we have been able to increase from cash and insurance, which carries higher RPOB and higher RPP and resulting into the higher EBITDA. So this is the reason in the precise why this EBITDA margin and EBITDA growth is showing. In terms of the profitability grew much faster than the EBITDA, which was 102%, because the depreciation and interest cost was very limited, and after paying the due tax, whatever amount was there is got added to the PAT, and it grew by 102% CAGR during the same period. On the balance sheet side, if you look at our CFO conversion to the EBITDA, we have almost we have been able to convert around 77% to 90% of our EBITDA into the net operating cash flow. The reason being that for very high conversion of the CFO in this year is that one is that we had some income tax related refund which has came in this year, and secondly, the government and the state-run authorities have released the payment much faster, resulting into the higher CFO to the EBITDA. But going forward, I think we should be able to maintain between 77 to 88%, which we have shown in FY19 and 20. Hospital sector in any case doesn't require higher working capital requirement, and as the payer mix continue to change in our favor and cash and insurance business continue to increase, our working capital consistently has come down to 1 day itself. And it is fair to assume that going forward, we should be able to maintain between 0 to 5 days based on the present payer mix. So what are the net operating cash flow we have generated over a period of time and working capital requirement coming down consistently? What are the surplus cash was generated by the company? It was deployed very judiciously for the acquisition of the strategic assets. In the last 4 years, we acquired 4 units, and for the growth capex of the company, and the balance has been used strategically to reduce our debt to EBITDA and our EBITDA, reduce our debt. So as on date, we are almost net debt free company, and we don't have a debt. In fact, we are a surplus company as on 31st March 2021. In terms of ROC, which is a true reflection of our operating efficiency, capital allocation policy, and the debt metrics, our ROC continued to grow over a period of time from 14% to 27% as the performance of the company continued to grow and acquired units constantly kept on growing as per our business plan, and it stands at 27% ROC during the period. And in a summary, we just wanted to highlight that if you look at our operating performance or financial performance in terms of the EBITDA and EBITDA growth and working capital management, debt ratio metrics, and ROC, I think we have been able to tick all the boxes in the right directions and probably much better than our peer group in the same sector in India. And we are AA minus rated by the CRISIL as on date, A1 plus for the short-term rating. Our statutory auditors are EY for the last 2 years. Before that, 10 years, the KPMG was the auditors, and internal auditors are PwC. I'm sure all of you must have gone through our RHP and gone through with our board of directors, a very judicious mix of various talent having in the various subject and the specialties. And I think their guidance will be very, very helpful in the growth of the company. They have been working into the various top companies of the India, and their guidance will be very, very helpful. With this, we will. I would like to close our presentations, company's presentation, and we can take up the question and answers.
Thank you, doctors, and thank you, Mr. Vikas. We will now open the floor for the Q&A session. While we have already received some questions and we will be taking those first, I do request everyone to post their questions in the Q&A panel. We will try our best to ensure that all questions are answered. The first question, you provide us the broad details of the exiting shareholders. Are any of the doctor shareholders exiting? And what percentage of their holdings are they selling?
So, yeah, so let me take this question. So, doctors and doctor family in the parent company, which is going for the IPO, holds roughly 12% of the equity as on date. And out of that, a very small portion of the doctors are exiting. And it is roughly 3% of the shares, which is coming from the doctors.
Thank you, sir. Post issue, the promoters would hold about 40%, while the public shareholding will be around 60%. Could you explain the rough or broad details of this 60%?
So broadly, the General Atlantic will continue to hold 12 to 15% of the stake of the company. The balance will be with the public, which is going for the offer. The offering size is roughly 33%, including the primary and the OFS. The balance will be held by the General Atlantic and the promoters, and the doctors who are with us.
9% will be the doctors, and 37% promoters and promoter group, and 20% is General Atlantic. 33% is the general public.
Thank you, sir. Next question. Despite having good growth in revenue, the company's expenses have remained stable or sticky, which has generated good improvement in profitability. Could you please throw some light on this?
I think for the last 3 years, a lot of the older facilities have reached an operating leverage. So if you look at the performance of the last 4 years, the EBITDA margins in the mature hospitals are actually expanding at 300-400 basis points. So every incremental revenue that keeps coming up in the mature assets after a certain point, or in the phase that we are in for the last 3 years, almost 60% of it is going straight to the EBITDA margins. And this year also, because we added programs like the heart and lung transplant, liver transplant, and a few other interventional procedures, which helped accelerate the growth of the mature hospitals. It also helped us expand it a little more than usual. But we've seen it even before the pre-COVID FY20, FY19, it expanded by 300-400 basis points. The year prior to that also it expanded by 200-300 basis points. But then it's a function of operating leverage that we are in.
Thank you, sir. Next question. Are you buying real estate and constructing new facilities, or are you going by the rental or leasing model?
So we're open to both the options. I mean, our preferred route is to acquire land and build out the facility, because we believe over a long period of time, the cost that you pay as rent, if you can leverage your balance sheet and buy out the asset, you will at least over a 10-year period start owning the facility, and the EBITDA margins will further improve. But having said that, real estate is a little expensive in certain markets. So, we are looking at few rental premises in markets like Karnataka, Tamil Nadu. We'll weigh the options and see what comes our way.
Thank you, sir. How have your revenue and profits improved dramatically in FY20 and 21, whereas you have incurred huge losses in FY 2019?
So take the losses part and then I'll talk about the market.
So this is a good question. I'm thankful that question is brought in. Actually, the losses which is being shown in the books is mostly is a non-cash item. In the previous, let me explain why this in FY19 there is a losses. We had the private equity ICICI Ventures with whom we had some certain agreements of providing the certain IRR or the fair market value, whichever is higher. So as per the India's accounting standards, if we have committed any IRR, that should not be treated as an equity and then it should be treated as a debt. So whatever the IRR or the fair market value was higher is being debited into the P&L and the respective losses has come. But if you look at our adjusted PAT, it is actually is a positive 50, which is being shown in the presentation and being highlighted into the RHP also as a separate section. I will encourage all the people to go through with the selective financial information which we have given, which shows the adjusted EBITDA profitability and the revenue of the company. So please go through with that. So excluding that, our PAT was 50 crore rupees, which grew to 115 crore rupees and 205 crore rupees over a period of last 3 years. So there was no such losses. If you look at the cash flow also FY19, you will not find any such entries of related to the loss because it's all non-cash entries because of the accounting we have passed those entries. Hope this clarifies with respect to the losses. As far as the growth in the revenue and the profitability is concerned, Dr. Abhinay will explain.
Conclude the next slide. So we classified two of our assets into two categories: mature assets and acquired assets. Let's talk about acquired assets. Acquired assets, we have the 4 assets that we acquired in the last 3 years, and it was in its ramp-up phase. So in FY20, on the acquired assets, we saw the EBITDA margin at around 5%. And usually, historically, if you look at all our assets, whenever we hit an operating break-even point, as in the case in FY20, the next year, there's a jump in the EBITDA by almost 10-12% purely because of operating leverage. I have to just give you a number and explain. Assuming that the acquired asset does 5 crores in revenue and hit a 5% margin, the minute it touches 6-7 crores of revenue, almost 70% or 65% of that revenue goes straight to the EBITDA, and hence the margin expansion. Along with that, because in the mature assets, we're already sitting on a high operating leverage, and the usual growth has been around 12 to 15% in the mature assets. This year, because of the heart and lung transplant program, where we did 53 transplants in 7 months, we added a very strong liver transplant team and other interventional procedures, helped grow the mature assets not at a 12-14%, but at a 28-29%. That is why the margin expanded beyond 400 basis points. But moving forward, given that it's the mature assets, we believe will continue to grow at a 12 to 15% kind of a growth rate and help the margins sustain or marginally expand. And that's why you see the FY20 number on an overall basis at 22%, because there's a drag on the acquired assets EBITDA where the revenue contribution is almost 20%, but the margin contribution is only 5%. And in FY21, not only did the mature assets expand, even the acquired assets hit a 17% margin, which helped the EBITDA, overall EBITDA grow from 22% to 28%.
Thank you, Doctor. How much time does it take to turn around a hospital into profits?
So, our experience in the past typically has been we are able to hit an operating break-even anywhere between the 9th to 15th month. All the 4 acquired assets that we did, we broke even between the 9th to 15th month. So that's been a typical experience in the past. And moving forward, also we believe we'll be able to achieve that kind of a break-even point.
Thank you. Next question. How has the company managed to increase revenues through FY21, whereas optically the number of patients were lower versus FY20?
So it's because so the number of patients when compared to FY20 is marginally lower. What helped us accelerate the revenue or the ARPP is because we focused on quaternary care work like the heart and lung transplant program and the ECMO program along the heart and lung program. So that has really helped us improve our ARPPs, improve the RPOBs, and deliver a higher growth rate. It just happened that it also coincided with this financial year, given the pandemic. I hope that answers the question.
Right, sir. Thank you. Yes, sir. Thank you so much. Next question. Why have the margins in FY21 increased despite elective surgeries generally getting postponed? Even most of the listed hospitals have just reached to pre-COVID levels margins at the end of FY21. What has KIMS been doing differently?
So I think our experience has been slightly different. So we operate in two states, AP and Telangana. As far as AP was concerned, the government very clearly put out a mandate saying all COVID patients will be directed to designated COVID hospitals. And fortunately, most of our hospitals were designated completely non-COVID centers. So for patients, it was very clear that you go to this kind of a hospital, it's non-COVID, you go to this kind of hospital, it's COVID. Except for 45 days in the interim, 45, 60 days, most of the time we continue to do a lot of the non-COVID work in all the hospitals in Andhra. So that's why we except for 1-2 months throughout the year and during the lockdown, we haven't seen any dip in the overall non-COVID work, whether it's elective or other therapy work. But as far as Telangana was concerned, yes, we've seen ups and downs in how things panned out. There was a huge blow in the volume in April, May. June, we saw almost 50 to 70% of the volume recover. So I said we performed almost 150% in the month of June because a lot of pent-up demand of April and May came back in June. And then July, August, September, we were completely inundated with a lot of the COVID work. But from September, COVID work didn't contribute to more than 5% of the overall volumes or 7-8% of the overall revenues. And 92% of the work was largely non-COVID, all the way from September to mid-March. And in fact, we saw the numbers come back much stronger than how it was in the pre-COVID time. That's been our experience in both the states that we operated.
Thank you, doctor. Next question. Do you have or have you seen any COVID-related advantage, especially in Tier 2 hospitals?
Not really, because in most of our Tier 2 hospitals are in Andhra. And in Andhra, the model was very clear that there are government-designated hospitals, which are absolutely COVID. And there are private designated hospitals, but based on certain criteria, you become a COVID hospital. So except for 2 of our facilities, almost throughout the year, all of them were completely non-COVID, except for the interim where the number of cases surged significantly. So we haven't seen any benefit because of COVID. Actually, if you annualize the Q4 number of FY20 for across the hospitals and add back the growth that it has historically delivered and the new clinical therapies we added in terms of inducting new doctors or starting new programs, you will see that the numbers in FY21 stack up very similar to what it did in FY20, adding back all these.
Thank you, doctor. Next question. Why are the promoters selling some of their stake in this offer?
We have a lot of debt was there. We pledged nearly 16.6% of the shares. One of the things which we pledged for nearly 4% the medical college, which is similar to medical education and healthcare. At that time, we want to do medical education in the main company. The board decided not to do, being a not-for-profit organization in an institute healthcare. As far as education is concerned, that's why we need to do on the family name. So we pledged it as a secondary collateral to the medical college, nearly 4%. Primary security is only the building and the land for the medical college itself. So that's why that 4% will still continue there. The rest of the things we borrowed some NBFCs and put into the other businesses where to help for my brothers. So now we are selling all those shares and clearing all the purchased shares, and that will be repaid the entire debt. So nearly post-COVID, I mean post-IPO, we may have to 4 to 5% max is the pledged shares for the medical school and others. But rest of the things we are going to release the pledge.
Thank you, sir. Next question. Investors have not made money in the last few hospital companies to tap the markets. What makes you confident and what are you doing differently?
Investors have not made money in the last few transactions. What makes you think that?
So basically, the entire thing was the one answer I could able to say if you look into the 3 years back, we filed the DRHP. At that time, along with us, there are 4 other 5 companies has also filed. This is the only one company which could able to deliver what we promised going forward the last 3 years. We delivered the number what was being done. So what we planned and what we are going to show and what our business model, both organic and inorganic growth, to sustain the growth. Moving forward, we have been already identified and planned in the next 1 decade, focused mainly on the regional area. And the reason why is you know that this country has a different mindsets, different cultures of different states and different political scenario. It is better to stay focused in one area to manage so many people in so many areas. So moving forward, also we are staying focused in South India mainly, Karnataka and Tamil Nadu, and as well as Central India and this one. So when we stay focused, and the other important thing, we mostly move on to the bigger units like 300 to 400 beds in Tier 1 and Tier 2, and 5 to 700 beds in Tier 1. So that will also give, once as we mentioned it before, the leverage once the maturity unit comes, the develop a EBITDA margins. So what we learned from our learnings in the last 2 decades. So with this, when they keep maturing and the EBITDA margins and the growth will be there once you build a good brand. So that's why I think for us, last 3 rounds of private equity, as I mentioned before, they made a good return of investment and all the small shareholders also. I'm sure, I don't know the reasons, but we are very confident that we can able to deliver what we promised and what we have been achieved in the last 2 decades. Moving forward in the next decade also, we can able to achieve the same.
Thank you, Doctor. Next question. Both Kovai and KIMS have more than 20% EBITDA margin, which is industry leading, and both are located in the south. Is geography the reason for such high margins?
I don't think so. I think at least the listed peers have a larger footprint currently, and whatever is presented is a mix of mature, semi-mature, and new essays. Hence, there's a drag on the overall margins. But if you look at a profile of all the mature hospitals, we have seen a lot of the hospitals, not just in South, also in North or Central or East India, where hospitals have been able to deliver 25 to 30% kind of a margin. It's just that it gets camouflaged with so many of their hospitals, some being, all of them being in different growth phases.
Thank you, sir. Your regional dependence is quite high. How are we planning to reduce this dependence? Are there any other regional risks?
Usually, healthcare, I don't think any risk is involved because healthcare is the one which requires most of the people. As long as we can able to do our job and deliver good quality care and affordable healthcare, definitely region is not going to do anything. Basically, most of the things, most of the peers, they have every state they have 1,000 beds like that. We are also having 1,800 beds in Andhra and 800, 1,200 beds in Telangana. The other important thing why South is doing well, if you look into the per capita income in South is much more and affordability is better. The insurance penetration and all those things are also better. That's why they may be generating good outputs, good revenues from the southern states.
Yeah, we don't see any risk from a regional presence point of view. It only is an advantage to us. Our ability to attract doctors, to have quaternary programs, ability to attract patients or other management staff is quite superior because of the way we are growing in one state. And there's so much opportunity in one state. Why look at beyond when you are able to scale and build large facilities?
Thank you, sir. Next question. How would you justify the price at which the IPO is coming out? Could you throw some light on the valuation?
I think the BRLMs can take this question because it is based on the guidance and the feedback of the bankers as we decided. So I will request the bankers to take up this question.
Yeah, I can take this one. If you look at the peer group on a price to earnings basis, or the peers, most of them have had a negative earnings in FY21, except for Apollo. And basis the earnings per share for Apollo, it is trading at a PE of 101. Versus that, KIMS, the offer price is trading at will be offered at 31x PE. I think the way investors also look at hospitals is on a EV EBITDA basis. I think on a EV EBITDA basis, this number is comparable across the peer groups, and that is how the price has been arrived at.
Thank you, sir. Next question. How much is the capex that we incur per bed, and how many number of beds do we plan to add in the next 4 to 5 years? How much debt will that require?
So the per bed on the blended basis is roughly 44-45 lakh rupees on the blended basis. For the tier 1, it should be at around 63-65 lakhs rupees cost, and for the tier 2 and tier 3, which we have built, is around 20. So the blended cost per bed with us is something like that 44-45 lakh rupees per bed. And going forward, since these assets, particularly the Secunderabad and Nellore and Rajahmundry, which we have built slightly earlier, 7 to 10 years before. Obviously, there has been some inflation and some medical equipment cost has gone up. So going forward, we believe that it should be in the range of 60 to 80 lakhs rupees per bed, depending upon the price of the land and the location where we want to build and the size. So that should be the broader range of per bed cost for the greenfield projects which we are looking at going forward. And as far as the debt is required, I think today we are, as on date, while we are speaking, we are a cash surplus company as on date. We are raising 200 crore rupees of the primary, 150 crore rupees going towards the debt repayment. With that, the cash surplus situation improves with the company. That cash situation will improve the company. And also company is generating something like that 300 crore rupees of the free cash flow as on date. And we expect this trend to continue and improve. So if you take a larger picture of 3 to 5 years, we are looking at something like that 1,000 to 1,500 rupees of the internal cash flow getting generated. And what was the growth plan which Dr. Abhinay has told that we are looking for a greenfield project at Chennai, Bangalore, and other locations as per our growth strategy, depending upon the board approval, etc. I think mostly it can be funded through the our internal cash flow. If there is some short-term mismatch is there on for 1 year or 2 years, we will, since we are a almost net cash free company, we have a leverage to take some loan and build that for the growth capex.
Thank you, sir.
Thank
Next
you.
question. The top 25 doctors account for 35% of the revenue. Is it a big risk if they decide to leave tomorrow? What do you do to address such a risk?
If the doctors, 25% doctors constitute significant revenue. If they leave, is a risk.
No, see, basically the persons they want to leave. First of all, that question does not arise since inception. They are there and they have been offered in between also better in double, triple the money what they are getting. The main focus for the doctors is the comfort of the management and how best they can treat their own patients, an affordable quality care and a good technology that is available. That's the only thing rather than money. The second important thing, the brand has been so much penetrated in the deep into the public, especially in this region of Andhra and Telangana. And we still get some patients from Maharashtra and Madhya Pradesh, Orissa, also neighboring states, and some of Karnataka patients. Even now, the brand has been so big and people keep coming. Only thing is what we need to get a good talented people who can able to deliver the quality treatment for the patients. I don't think it's a big risk at all.
Thank you, doctor. Next question. You mentioned that 50% bed capacity can be increased within the existing network. Can you throw some light on the timelines and the annual capex that would incur?
Sorry, Gaurav, could you repeat the question again?
The capacity in the existing to improve the capex.
So I'll just repeat the question. You mentioned that 50% bed capacity can be increased within the existing network. Could you throw some light on the timelines and the capex requirements for this?
No, so I don't know where this number came up from. We're currently at an occupancy of 60% on the overall bed capacity. We've usually seen mature hospitals to go up to almost 75 to 80%, which itself is around 500 beds potential within the current hospitals. And we said we can add more capacity through greenfield and acquisition, plus expanding our current hospitals. We're looking to add close to 500 beds in our current hospitals across the 9 facilities over a period of next 36 to 40 months.
Thank you, doctors. Thank you, Mr. Vikas. Does being in medical education help raise the talent pool for KIMS?
Being in medical education help.
Yeah, definitely. See, basically, some of the postgraduates, we have 250 students are getting trained. We have 750. And a lot more we can able to have the neighboring Vizag and Srikakulam. Those poor patients can go there, grant and improve. And those who are good at, and they can come and mutually you can able to get benefit out of both the places. We can take the good talent to in the near future where they want to establish some hospitals. This definitely will help.
Thank you, sir. Next question. For the past 3 financial years, company revenues, EBITDA, PAT, and margins are increasing gradually and significantly. Where would this trajectory lead, and what are the workable, stable EBITDA margins going forward? If you could throw some light.
Okay, let me take this question. Historically, we have been able to grow a company by 20% CAGR with the blend of both existing company, existing hospitals growth, and with the growth, with the acquisition of the few hospitals, we have been able to keep our growth at 20% CAGR over a period of time, both revenue and EBITDA. And we aspire to do the same in the coming years also. So depending upon the opportunity availability, we will be definitely looking at carefully and with the board approvals, etc., we will be taking the company forward. So that is our aspirations to grow our company 20% CAGR, and depending upon the opportunities, we'll take this forward. And as far as the EBITDA is concerned, as Dr. Agnay has told, our mature units is almost at 32% trajectory, and we believe that we should be able to maintain that. And as the acquired units are growing consistently and then improving their EBITDA profile, if we continue to grow our hospitals, acquired hospital consistently, we believe that we should be able to grow our margins slightly in the coming years and keep maintaining it.
Thank you, sir. Next question. What is the annual impact of Ind AS 116 on your EBITDA?
So thankfully, we have only one hospital for which we pay the rent, which is Hyderabad Kondapur facility, and it should be at around 3 crore rupees, which is the impact because of this Ind AS.
Thank you, sir. Why is our ARPOB in Kondapur so high at nearly 45,000 rupees?
So Kondapur facility actually is a 250-bed facility, and it is in the different market of the Hyderabad, and we have earmarked that facility only for cash and insurance patients. Very limited work of the corporate business which we do, which is less than 10% or maybe less than 7% of the revenue coming from the corporates. So it is a cash and insurance facility. So that is why this ARPOB is slightly higher compared to the Sikandrabad or other facility, where we do a lot of other corporate business and ROV business.
Thank you, sir. Next question. How has the company managed to outperform its peers on operational ratios, and what is it doing differently?
I think the model that we built or we believe is to have large format hospitals and not focus on pricing, but focus on volume and cater to all sections of the society, whether it's a scheme patient, it's a corporate patient, a cash patient, or an outpatient patient. So we try to create a facility with large volumes, put in all clinical therapies, benefit from the volume that comes in because of these clinical therapies, and also be able to accommodate future volumes. So that's why for us to show these kind of operating leverage and these kind of margins, it's crucial that we get to a certain volume and revenue before we are able to put this off. And once we get to that number, when it takes 3 years, 4 or 5 years, we have the ability to expand that capacity. That's where we are able to really attract these kind of margins in most of our hospitals.
Thank you, sir. There are a number of questions on the expansion plans, so I'll just club them into one. Could you tell us a little bit about your expansion plans and what geographies you intend to get into?
Sure. So like I said, we have 2 strategies. One is to expand within AP and Telangana, and one is to expand outside AP Telangana. So AP Telangana expansion, we're looking at deploying from 500, 600 beds within our existing campuses. We're looking at adding a greenfield project in the city of Hyderabad, and there's a consolidation opportunity in the city of Hyderabad. So this will help us scale and increase our bed capacity by close to 40-50% over a period of 3 to 5 years or 5 to 7 years. But beyond this, we are looking to start our anchor hospitals in places like Tamil Nadu, Chennai, and Karnataka, Bangalore. The idea is we start small with a 250, 300 bedded hospital, but be able to scale it up to a 700 bedded hospital over a period of time. And that becomes our anchor hospital. Keep leveraging on the strengths of the anchor hospital, we then start looking to create a network in Karnataka, in Bangalore, and then in the tier 2, tier 3 markets of Karnataka. Likewise, we scale in the city of Chennai and then create tier 2, tier 3 markets in the state of Tamil Nadu. The reason we have chosen these markets is the cities are only growing larger and larger. Currently, in the last decade, each of these cities, Hyderabad, Bangalore, or Chennai, the newer micro markets today account for almost 20-30% of the population. A place like Hyderabad has added close to 5,000 beds in these new markets. But a place like Bangalore and Chennai together have not been able to add more than 1,000 to 1,200 beds over the last 1 decade, both the markets together. And if you look at the players who set up hospitals in these markets, are not the ones based out of that market, but these are guys who are fresh to the industry or very new to that micro market. So what really worked for them, and we've seen this work even in Hyderabad, is it really is not so important that you have the brand and all of that pull, but what is the problem that you're trying to solve? So the guys in Karnataka, in Bangalore or Chennai, the problem that they tried to solve, and they were extremely successful, is approachability. They set up a new hospital in a catchment that had huge supply-demand gap. They set up a very good infrastructure, attracted great technology, that attracted great talent. Once you have a mix of both of these, you're bound to get a lot of patients given the supply-demand gap. So we believe that the supply-demand gap is still there, a lot of gap in these new micro markets. And because the cities are only going to get bigger and bigger, it makes sense that we get into the market through these new micro markets and then expand when the market is also expanding. And the tier 2, tier 3 player, the current markets, the organized market is around 700, 800 beds at best, the largest player operating out of those markets. But in Andhra, we've been able to scale up to 2,000 beds, and we're further adding more bed capacity. So I think there's great opportunity to organize the tier 2, tier 3 markets in Karnataka and Telangana. Hence, we're choosing this mode for our expansion in southern India. And central India, I think there's a huge vacuum there. Again, parts of Maharashtra, Madhya Pradesh, Chhattisgarh, Bhubaneswar, all of them drain into Hyderabad traditionally for treatment because of proximity issue. And given the supply-demand gap and given the need for better infrastructure, larger format infrastructure, we believe with the strengths that we already possess from these markets, we'll be able to expand to those markets. But our priority is to put capital in Karnataka, Tamil Nadu. We're looking at acquisition opportunities in central India. If anything comes by, we'll look at it. Otherwise, the priority will be to focus in Karnataka and Tamil Nadu.
Thank you, Doctor. Next question. Are the payments from government welfare schemes getting paid fully?
Yeah, from the government schemes, we have seen that the payment comes because there may be a question of delay from the government, but there is no question of any bad debts from the government dues. The government dues comes if the paperwork is perfect and we answer all the queries of the organizations. The payment from the government organizations will definitely come. There is the issue of there may be some part of the disallowance, etc., of 5-6%, but the payment comes from the government. Of late, for the last 18 months, we are seeing the government also releasing the payment very promptly. So that is what is being reflected in our working capital. Working capital days also, if you see, it has come down because of that. So government payments for the last 18 months, we are seeing it's coming smoothly.
Thank you, Vikas sir. Next question. Are we planning to get into diagnostics or any other related business? Could you also elaborate a little on what we are doing on the digital side?
Right. So I think our focus is to stay very clear on the tertiary quaternary care services. We don't intend to do the diagnostic or pharmacy play. However, having said that, given the network presence that we've been able to create in AP and Telangana, or that we intend to create in Karnataka, Tamil Nadu, and Central India, the long-term belief or the plan is the volume of patients that come into our hospitals and the number of follow-up work that needs to happen for these chronic patients or acute patients on the lab and pharmacy is quite large. And we would want to tap on that continuum of care to capture that data, help them get medication on time, help them to their medication plans, and build the diagnostic protocol for them. That's the plan, but that's going to be an extension of the work that we're doing at the hospital and not be a pure play diagnostic or a pure play pharmacy kind of a model. This is the plan, at least for the medium to long term, but maybe after we execute the larger plan of having a larger network, we'll probably look at evaluating these opportunities.
Thank you, sir. Next question. What is the dividend policy you intend to follow, given that you are a cash-rich company?
Okay, so far, whatever the free cash flow is being generated with the company, we have deployed for the growth capex and growth capital investment in the company, and we have been able to grow that. As you told correctly, that now the free cash flow is very sustainable, and we have going forward, we have a visibility. So depending upon our growth plan and the internal cash accrual, we will, depending upon the board approval, we will look forward to give the dividend to our shareholders.
Thank you, sir. There are a number of questions on the Chennai project. What is the bed capacity planned and the total capex estimated? And when is it approximated to come online? If you could throw some light.
Sure. So we've already acquired land last financial year. It's a 4-acre land parcel. The intent is to build a 550, 600 bedded hospital. But this will be, the capital for that will be deployed over a period of time. We will deploy capital only for the first 250, 300 beds, which could be to the tune of 80, 90 lakhs typically per bed. And once we scale that operations, we will then look at deploying capital for the incremental beds. But the long-term vision that we have for that particular location and facility is to scale it up to a 550, 600 beds.
Thank you, doctor. Next question. What was the driver of lower doctor costs during FY21?
I think the lower doctor cost, the numbers have been very similar to what it was in FY20. But when you look at the acquired assets, given again operating leverage, the hospitals that we recently acquired, all the doctors are on a fixed pay model. So when the company started generating more volume and more revenue at a certain fixed pay, it helped improve it helped expand the margin. But we haven't done anything differently on the doctor cost vis-a-vis FY20 and FY21.
Next question. Your length of stay is about 5 days, despite having automation in surgery. What is the reason for such a large length of stay? And is there plans to bring it down?
Yeah, I mean, yes, there is obvious scope for improvement and plans to bring it down. There are 2, 3 reasons why it happens. The general behavior that we have seen for the patient is we don't want to push them too hard for discharge because they feel more comfortable to stay one extra day at the hospital. And at few of our hospitals where we're really running high on occupancy, we then take steps to reduce the ALOS. But in the hospitals that are low on occupancy currently, we don't want to pressurize the patient to get discharged so that we can accommodate another patient at the same bed. That is one reason. Number 2, a lot of the Andhra hospitals work on a 30% volume that comes from state government schemes. And the way the scheme is designed, that you need to admit a patient 1 day prior to the approval. The discharge process is a little longer because it's an online process, which also expands the length of stay than usual. And also given our heavy work on the cardiac and organ transplantation, we have seen the length of stay to be higher given the number of cardiac surgeries we do or the number of neurosurgeries that we do. But I think there is scope for us to improve the length of stay, and we are definitely going to work on it as and when.
Next question. There is a lot of support in terms of medical insurance, which is provided by the state of Andhra Pradesh, which may not be there in other states. Will it affect or guide your growth plan?
Not really. I think thanks to the Ayushman Bharat program, now this kind of a scheme is probably present in every district of the country. So we don't see that as an issue. And also the program that has been there in markets like Karnataka and Tamil Nadu are quite stable, and they've been there for quite some time. So we don't see that as a challenge at all.
Thank you, sir. Out of your top 25 doctors, how many are exclusively practicing only at KIMS, and how many work as consultants?
So the model that we practice at KIMS, all doctors are consultants of the hospital. They are not full-time employees of the hospital. Having said that, even if you're a consultant, you have to just practice at KIMS, or you can run your own clinic in the evenings. You're not allowed to practice, even if you're a consultant, at any other hospital other than KIMS. So we don't have a part-time kind of or a visiting kind of a model. All of them are full-time consultants at the hospital.
100% consultant exclusively to work only in KIMS.
Understood, sir. Thank you. With that, we come to the end of the Q&A session. Now let me invite Mr. Shirish Chikalge from IIFL Securities to give the vote of thanks.
Good evening, ladies and gentlemen. Let me take this opportunity to thank the broker and analyst community for the patient hearing of KIMS' unique story. We are all well aware of the massive infrastructure gaps in the country's healthcare sector today. It was all the more evident during the ongoing pandemic. As a result, we think there will be significant push from government, central, state to enhance the healthcare spending over the next 10 to 15 years. Private health chains such as KIMS will be a key beneficiary of this large spending. While there are multiple healthcare chains in the listed space, KIMS is possibly the only hospital chain which has perfected the model of providing healthcare services of global standard at affordable prices, while consistently delivering superior margins and returns to shareholders, as evident from its financial performance over the years. This particular key differentiator has been well appreciated by many of the marquee global and domestic funds, and as a result, we are likely to see a very strong demand from them in this issue. Lastly, we seek your support in communicating this unique story to your clients and ensure a strong participation in this strong growth compounding story. Thank you very much.
Thank you, sir. And thank you everyone for joining the virtual brokers and analysts meet of Krishna Institute of Medical Sciences Limited for their forthcoming IPO. Please feel free to reach out to us for any further queries or email us at ipo@kimshospitals.com or ipo@adfactorspr.com. We will do our best to ensure that your queries are responded to within 48 hours. Take care and stay safe. Thank you.